In our previous videos, we covered various reversal patterns. Now, we're moving on to today's topic, where we'll dive into continuation patterns and neutral patterns. Continuation patterns are incredibly useful because they help us spot opportunities where the trend is likely to continue after a brief pause. On the other hand, neutral patterns give us signals of market indecision, where a breakout in either direction could lead to a new trend. As you may know, the market moves in waves with ups and downs. During these fluctuations, specific shapes or patterns often form on the chart, which we refer to as chart patterns. Examples of these include flag patterns, rectangle patterns, pennants, and more. Studies have shown that when these specific chart patterns appear, they tend to repeat historical movements. For example, take the flag pattern. In this pattern, two trend lines move in opposite directions, converging towards each other, and the price action becomes tighter within this range. Let's talk about the bullish flag pattern. A bullish flag is a continuation pattern, which means the price is likely to continue moving in the direction of the previous trend. In a bullish flag, after a sharp upward movement, the market consolidates, with two parallel downward trending lines forming the flag. Once this flag pattern forms, we wait for a breakout above the upper trend line, as it often signals a continuation of the upward trend. Similarly, there's a bearish flag pattern. This forms when there's a sharp downward movement followed by consolidation with two parallel upward sloping lines. A breakout below the lower trend line can mean a continuation of the downtrend. Next is the pennant pattern, which can also be bullish or bearish. In a bullish pennant, a sharp upward move is followed by consolidation, with trend lines that converge as they move in opposite directions. Once the price breaks above the upper trend line, it often signals a continuation of the bullish trend. The bearish pennant is the opposite, a sharp drop followed by a consolidation phase where the trend lines converge downward, and a breakout below the lower trend line could indicate the continuation of the downtrend. Now let's understand rectangle pattern. This can be either bullish or bearish. During a trend, if the market consolidates between two horizontal levels, acting as support and resistance, it forms a bullish rectangle. When the price breaks above the resistance level, the trend usually continues upward. In a downtrend, if the market consolidates similarly, it forms a bearish rectangle. A breakout below the support level suggests the downtrend will likely continue. Now let's understand the real chart. This is the October 29th gold chart on the 15-minute time frame. After a strong upward move, the price doesn't keep climbing straight up. Instead, it takes a pause. This pause is what we call a consolidation phase. In this phase, the price begins moving sideways within a tight range, creating a pattern we refer to as a flag or pennant. So, why is this important? Well, the flag pattern often hints that the market is simply catching its breath and might be preparing for another move in the same direction. If the price breaks out of the top of this flag, it could mean the uptrend is ready to continue. In short, after a solid upward trend, this flag pattern suggests that gold might have more room to rise if it breaks out above this consolidation zone. Patterns like these help us anticipate what the market might do next, so never forget to practice. Now let's understand neutral patterns. The symmetrical triangle pattern forms when two trend lines converge toward each other. Here, the upper trend line slopes downward, while the lower trend line slopes upward, creating a narrowing price range. This compression suggests that buyers and sellers are struggling to establish control, causing price fluctuations to get smaller as the triangle closes. For trading in the symmetrical triangle, wait for a clear breakout with significant volume before entering a trade. Set a stop loss just outside the triangle's opposite trend line for risk management. Remember, patience is key with continuation and neutral patterns. Waiting for a confirmed breakout with strong volume can make all the difference in your trading success. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to Trader D for more insights into trading strategies and market patterns.